another factor is more and more people are becoming investors. And so, yes, there may, if you took that question in a vacuum, or that scenario in a vacuum, you might see some volatility, you might not. But I think the fact that more and more people are becoming investors into the stock market, whether it's directly or indirectly through mutual funds and or ETFs, I don't think that to the average person, they would see the volatility.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt here with Lee.
Good morning.
Good morning. How are we doing?
We're good. Yeah, we survived the SpaceX IPO last Friday.
Yeah, survive is a good way of putting it. There was a lot of, I don't know if angst or just anticipation,
excitement. There, yeah, all the
worry.
emotions.
I mean, there were, yeah. So we'll get into that. So we're going to talk about SpaceX today, just kind of the IPO, historic IPO on Friday. So now we get a few minutes to talk about kind of after the fact, how it went down, how the market reacted. And then we're going to get into, we got a question from one of the listeners, I think it was 2 weeks ago. We got an email that I wanted to kind of talk through and then kind of parlay into a very similar topic that's very closely related to what his question was. So couple good topics today. So SpaceX, let's jump into that. So SpaceX IPO'd on Friday, $135 a share. There were so many different reasons this was a historic IPO, not just because of the size of the IPO in terms of, the market cap that they were coming public at, but also the amount of money they were trying to raise. Mm-hmm. But it was historic in the way that they went about it, right? There a lot of, most of the time IPOs come out and they say, hey, we're looking to raise this amount of money. You go around for a few weeks before the IPO to institutional investors, family offices, all of the above, and say, hey, what's the interest? How much you want? Where's the price? And, a lot of times they'll give a range saying, hey, we're looking at, IPOing at, in between $100 and $120 a share. And you don't know what that price is going to be until kind of after the roadshow, mm-hmm. right? And after you've gauged interest, sometimes it comes in light, which is obviously not a good thing for maybe the stock in the short term, because it's like, okay, appetite is light. And sometimes it comes in higher than expected. Yeah. And so they end up raising more money than they maybe even set out to. This was unique in that, I'm going to say Musk. I'm sure there were others involved, but Musk, kind of the ultimate authority in the room said, hey, it's $135. Take it or leave it. How much you want, right? And so that was unique. What was also unique was how much of the IPO they were giving allocating to retail investors, mm-hmm. right? Initially, it was 30% of the IPO, which is much, much higher. I think 5 to 10% is kind of more normal. So they were saying, hey, 30% of this IPO is going to go to retail investors. Now, because of institutional demand, they ended up lowering that kind of last minute. And I don't know what it kind of finally came in at, but right before the IPO, they said, hey, it's probably going to be closer to 20 or in the low 20s mm-hmm. percent that gets allocated to retail. But a lot of demand, and the price, showed that on Friday.
Just to educate our listeners and viewers, the IPO is, without going into a lot of details, is the opportunity for the company itself to get money. And in this case, billions of dollars. Once a stock is trading on an exchange, the NASDAQ or the New York Stock Exchange, for example, that money's just going between buyers and sellers. Mm-hmm. It is not actually going to the company. And so there's a lot of pressure on the C-suite, the investment bankers. In this case, it was Goldman and Morgan Stanley and a few other.
It was basically everybody, I think, except for Jefferies.
Yeah. And so there's typically a lot of pressure on them to get that price right. You don't want to leave money on the table. And in this case, Musk, pretty much assigning a dollar figure, and they got real close. Yeah. You don't want to see that stock, go up, 100%, because then you think, man, we left a lot of money on the table. In this case, it settled up. What was it up the first day? 15% or so.
I think it was 20. It was around 20%, and then it was around 20% yesterday.
Yeah.
And then pre-market this morning,
up about 5.
it was like 5 or 6%. So
yeah, it's
11% now.
Is it? It was a fascinating story all around. I think a lot of things were done correctly. Now we're sitting here talking about the IPO itself. We're not talking about our feelings on the company and so forth.
Sure.
But, there's a lot of a feeling out there that, it's Musk. And, a lot of those folks are investing in him.
Yeah.
And because of his track record with some of his other companies. And so it will be real interesting to see, kind of what takes place, how they use those funds. They announced today a pretty big acquisition in the AI world. So they're already putting some of those funds to use. So anyway, it'll be interesting to see how things play out in the days, weeks, and months to come. But, a lot of people, that was the story Friday afternoon. A lot of, rank and file employees that have been with, SpaceX from the beginning.
A lot of millionaires.
Cafeteria workers, janitors, people who had worked for years and years without a salary.
I think the last number I saw was there were going to be 12 billionaires created. I want to say it was was it 400 or it was a large number that was going to be over 100 million.
Yeah. So, these people got rewarded for, potentially years of, underpay and just having a belief in, again,
what they're trying to build.
And so it'll be exciting.
Yeah.
It'll be exciting to see. So, and, one more thing on SpaceX. What was very interesting, did you hear about the group of 100 or so employees that unionized and then essentially went together to a wealth management firm to negotiate?
They were like interviewing some of the biggest wealth management firms and, saying, hey, we want to unionize. Yeah. And, interesting.
Yeah. Very clever.
Yeah.
So, anyway, it was a fun Friday
to
watch it all take place.
There was a lot of different opinions on, the IPO, because there's so much money. Obviously, demand was there from institutional investors. Anthropic, OpenAI, some of these companies have raised many, many, many billions in the recent months in the private markets. Mm-hmm. So there was a lot of people saying, hey, this isn't, they're not IPOing because they can't get the money.
Right.
They're IPOing for liquidity for all of their old, long-term investors. And I'm not saying this is true. I'm just kind of putting out what was out there and kind of some of the opinions, And so you had the opinions of people saying, hey, they're allocating so much to retail. This is a liquidity event for long-term investors. And basically a bunch of wealthy people who've made a boatload of money are going to hand the bag to the retail investors and they're going to get burned, right? So that was kind of one of the themes that was out there, which I get not in terms of that they were trying to do something intentionally, but I get this. I get the question of like, why are they IPOing now if they can go out and raise the money? But then the other side of the coin is like, well, how long do you wait and how big do you get before you IPO?
Yeah.
Right. At some point, I think you got to say like, hey, if the long-term plan is to be a publicly traded company, we're going to wait till we're a $6 trillion company and IPO at the highest valuation in the world. I mean, that was kind of what they were on the trajectory to do. So, just a lot of really interesting, fascinating headlines around this IPO. The markets, I mean, the stock has ripped since then. It hasn't had, and I'm thankful for this, in the first few trading days, in the initial trading day, it didn't have like the 90s, early 2000s kind of IPO where it like is up 75, 80, 100% day one, which I'm thankful for. I would not have wanted to see that.
Right.
Because that just tells you, hey, there's no regard for price valuation whatsoever. It's just, indiscriminate buying. Now, we had 20% Friday. We had 20% yesterday. And it's up 10% this morning. Yep. So, the longer that goes, I think the more you have to just look at like, okay, how much of this is just people blindly buying and people actually investing? What that means in the short term, I have no idea. But
FOMO is real, even in the investing world. You mentioned some of these other companies. We're halfway through the year. But the back half of this year could see, a few more monster
Yeah.
IPOs. You've got OpenAI is set to go public later this year. Anthropic, Canva. So you've got some big names in the tech and the AI space and so it'll be interesting to see how much capital is still there that's wanting to be involved in this. But SpaceX is now the largest by market cap company in the world, and people forget this is not a new company.
Wait, SpaceX is what?
Their market cap. I mean, just past Amazon.
Yeah. Okay. Yeah.
Just past Amazon. But people forget this is not a new company. It's a 25-year-old company, to your point, that has waited a long time to get to this point.
Historically, they would have, if there hadn't been so much money in the private markets and they hadn't had the ability to get the money that they needed, they would have IPO'd
long time ago.
Years ago.
Yes.
Which a lot of people wish they would have.
Yeah. And it's a different world when you're a publicly traded company versus private. Before, Musk called all the shots. Now he's got to answer to shareholders
we'll get the information we will have at our fingertips now, on revenue and long-term plans and profitability or the lack thereof. It'll be really interesting, fascinating stock that is going to be fun to keep up with over the coming months and years. We got a great question from one of our listeners a couple weeks ago that I kind of hit pause on last week, but I wanted to circle back to it. And I think I understand what he was trying to ask. And if we don't, would love to get kind of a follow-up question on this from the listener. But we're going to kind of answer this directly and then kind of parlay it into a similar topic that's related, that actually is something that I was wanting to talk about. So I think it's a good segue into that. This listener's question was, prior to the advent of mutual funds and ETFs, investors bought individual stocks. If the current exodus from individual stock transactions continue to decline and funds continue to rise, how does that impact the market moving forward? So his thought. So a couple things I want to both answer and then maybe even slightly correct, kind of with some assumptions.
Will you ask his question one more time? Because I want to.
Yeah, prior to the advent of mutual funds and later ETFs, which mutual funds have been around. I don't know when mutual was. That's
a long time.
Been a minute. Yeah, ETFs are newer, but investors were individual stock buyers and sellers, right? Invested in individual companies. If the current exodus, so he's assuming that there's a exodus from individual stocks to relying more and more on funds and ETFs, continues. How does that impact the market? Does it lead to more or less volatility? If the only people, and I'm putting somewhat kind of putting words in this listener's mouth, but if the primary buyers and sellers of individual stocks are the funds themselves and not retail investors, how does that drive the market moving forward? So let's touch on that and kind of what you think might be, accurate in his assumptions and his question, and then answering it, and then we'll swing into what I was wanting to cover.
Well, let's keep in mind that mutual funds and ETFs, index funds, own individual stocks.
Right.
Okay. So,
which let me say, he acknowledged later in kind of his comment that was outside of his question.
Okay. That is an interesting question. I don't think that. Man, there's a lot of layers to peel back. I think if you take that in a that scenario in a vacuum, you could see some volatility. But I think the other thing that another factor is more and more people are becoming investors. And so, yes, there may, if you took that question in a vacuum or that scenario in a vacuum, you might see some volatility. You might not. But I think the fact that more and more people are becoming investors into the stock market, whether it's directly or indirectly through mutual funds and or ETFs.
Yeah.
I don't think that to the average person they would see the volatility that he's questioning.
Yeah, I think so. There have been so many. I don't even know. I should have came with some data on this, but there have been thousands of ETFs launched in the last few years. Right? I mean, just a crazy number of ETFs. I think the last several years, year over year, is like every year we've set new records on the number of ETFs launched. And I mention that because these have become, these are not your old school. These are not your Fidelity Contra Fund
Correct.
funds. These have become easy to deploy strategies where you have ETF and fund providers launching funds simply for the fact that it's like, hey, this is what people are wanting. We're going to do it inside a fund and launch it. And they're just starting funds left and right. So if there's a trend towards like meme stocks, there's a meme ETF. If there's a trend towards, covered calls on Tesla, there's a covered call Tesla ETF. There's, we have so many different types of ETFs now that are essentially doing what retail investors are wanting to do in their own accounts. Just these funds are trying to make it easier and simpler to capture that kind of a trade in one ticker.
Sure.
So I think because of that, it's like it doesn't change a whole lot. Like the trade is still happening.
Sure.
It's just who's doing it, who's clicking submit, and it's either the retail or the fund provider, the ETF provider. Either way, it's happening.
Yeah.
So I don't think it changes a whole lot in that regard. And there's pros and cons with all of these ETFs, right? There's value to making access to these kinds of strategies simple. I think there's a lot of junk out there. A lot of just products that in my opinion, Matt Walters' personal opinion, just shouldn't exist. They're not adding value to clients. They're created because they know they can be sold.
Sure.
Right? They're marketable.
And to your point, in the last 5 years, at the end of 4,500 new ETFs, not existing.
Yeah.
New ETFs came on the market in the 5 years.
And the reason the one reason I'm not a fan of all of these ETFs getting launched is because a lot of these strategies and things that these ETFs are doing can be done in an individual account, but a lot of people that are buying these ETFs doing wouldn't be people that would try to replicate that inside of their account.
Correct.
Even if they wanted to, they wouldn't say, okay, I'm going to buy Tesla and sell covered calls against it.
Well,
fairly simple, right? And some people will do that and would do that. But a lot of these people that are buying the ETF maybe wouldn't, right? They don't have the time. They don't want to have, spend the time. Maybe it's a little intimidating trying to think about how do I go about doing that. And so I don't think access, I want people to be able to do whatever they want, but I don't necessarily think that doesn't mean it's a good investment.
Sure.
Right. And so, I think it's great to have options. I think you get to a point where like, okay, we've got enough options. Like now we're just creating, and there's no new value being added.
Correct. I mean, most of the ETFs that are being created now are not these broad index based. They're very niche. I almost said something a second ago and I stopped myself because I'm not exactly sure how accurate it is. But, investing should be primarily for long-term investors. Mm-hmm. You could almost argue that some of these ETFs that are created for short-term niche type themes, if you will. So, to your point earlier and kind of what I said before, rather than 100 people going out and buying, 10 shares of SpaceX, you've got an ETF that theme is, outer space, going out and buying tens of thousands of shares of SpaceX.
I do think technology and the dependence on funds or the more people use funds, I do think it can lead to shorter term volatility and bigger moves in the market because you have larger trades, right? You have
correct
with technology and these algorithms that are making these tactical decisions for strategies and family offices and hedge funds. Something gets triggered. It's like 1 + 1 = 2. It's like, hey, we go below 200-day moving average. We sell X, mm-hmm. right? There's not thought going into it
right
in the moment. It's just a reaction. And so the same with the ETFs. If there's an event where it might be like, okay, we're going to trim this position, we're going to sell this position, that may have happened if all of these people had owned this in their individual accounts, but it wouldn't be happening at the exact same time.
Correct.
That fund is going to sell that position or, trim that position at once, maybe creating some short-term volatility in an individual name. And that wouldn't happen in a single day or single week if it was owned individually in all of the retail accounts. So because of the size of the trades and the grouping, of those allocations, I do think it can lead to more short-term volatility. Now, what I want to segue into, though, is what we've seen over the last few years. Because of technology and all of the things we just talked about, there's actually kind of it's a slow trend. It's not been a wave by any stretch, because we just talked about how many new ETFs have been out there, and the ETF, the money going into ETFs is just insane. So that trend has continued. That wave is still very much a wave that people are riding. But because of technology and what we have access to, not only as advisors but on the retail side, with things like direct indexing, tax loss harvesting software and things, people are now able to kind of build their own ETF, their own strategy in their individual accounts without having to be as dependent on funds and ETFs.
Yeah, I mean, it's to your point. I mean, and I don't know when mutual funds began, but I know
I was looking at it a long.
I know. I remember my parents when I was a child. They invested in individual stocks. And then it went to mutual funds, and then the mutual fund industry changed, and then you could get no load funds. And then the first ETF was, basically the SPDR, which invested in the S&P, and then it became index funds. And then and again, to your point, and now we're shifting back to.
Now we have individual stock ETFs.
Yeah. And now we're getting back through the bit with the help of technology to where we have clients going back to owning individual names for specific purposes.
Yeah, I mean, I think there's not a right or wrong, better or worse. It's just optionality, and I think technology has allowed us to not only a lot of these ETF providers to very quickly and efficiently launch ETFs, but a lot of that's due to technology, right?
Sure.
And innovation. But the same is true, at the retail level, being able to create your own strategy in your account and not depend on fund providers. And so with direct indexing and some of these things, you can say, hey, I want to have general exposure to the S&P 500, X financial with a tilt towards, XYZ. And you can go in and put these parameters and build that kind of a strategy with individual names in your account, right? And so you just have that as an option now. I think the ETF wave is going to continue. People like simplicity, and
Sure.
so I think people will continue to value that. The cost of ETF funds has come way down, so that's not as much of a barrier for investors.
And I do think that is an overriding thing, that cost is driving a lot of this. Is
Oh, sure.
Yeah.
I mean, because you go back to when mutual funds originally came out, right? You front loaded.
They were expensive.
Yeah. Right. And even when they weren't front loaded, there was no load. They were still expensive.
Sure.
Right. And it's hard to communicate the value if you're a fund provider to the individual investor. One, when you're not directly communicating with them most of the time. And trying to communicate, hey, here's the value we're bringing, whether it's outperformance or lower volatility or whatever it may be, tax benefits within the fund or whatever. It's just hard for them to do that. And I think they've learned that over time. So like, hey, we have to get costs down for people to continue to use this. And because of the technology and people being able to do this in their individual accounts, I think that's going to continue to put pricing pressure on the fund providers. If your only value add is, hey, we can give you access to a strategy, then it's like, well, I can build that on my own.
Right.
Tell me why I pay you. So a lot of really interesting things. I don't think it necessarily impacts the market, kind of going back to this listener's question, from a volatility perspective, other than what I mentioned earlier on just the size of some individual trades.
Yeah.
But that's probably volatility in over a day or a week, not longer term, right? Just seeing some bigger moves in individual names.
It was an interesting question. I mean, he had obviously kind of thought this through, and
and what we've seen, it's crazy. Just looking back at my career, right? I've been in the industry for about 14 years now, and just in that time, the evolution and how things have changed, right? And ETFs, the big thing for years was, hey, how much more tax efficient ETFs are than mutual funds, and some of the tax benefits of ETFs over mutual funds. Well, now we're starting to see, the push towards tax efficiency outside of ETFs. It's like, hey, that's true. ETFs over mutual funds offer certain tax benefits, but here's everything you're giving up from a tax perspective if you're using an ETF versus individual stocks.
Yeah.
And the ability to tax loss harvest and the ability to, and so, it'll be crazy when we're sitting here in like 5 years and we're looking back and like, hey, this is, the new trend, the kind of the value that's been created. So, I think my takeaway is like, hey, don't get too stuck in your ways. Don't get so, strong in your opinion, and don't let your conviction get so high in a particular product, a particular investment, where you're blind to what's coming, because technology and innovation is happening quickly, right? And it's coming at us. And so you have to be ready to adapt and adjust when it makes sense to make sure you're doing what's best for you and your situation.
I mean, 3 years ago, were we even hearing the term AI? I mean,
I wasn't.
Not much.
Yeah.
But
well, and, on this ETFs conversation, I saw this, the number of ETFs have already been launched on SpaceX.
Yeah.
I mean, it's like 2 times leveraged SpaceX. You're seeing this wave of ETFs that were in the queue that as soon as this thing went, it's like, hey, we've got approval and we're launching this as soon as it's traded, we're able to trade it. And so you can go out there and buy ProShares has a SPCF, 2 times leveraged SpaceX, right? Leverage shares has a SPCH. It's like, here we go.
Yep.
There'll be dozens of SpaceX ETFs launched in the coming days. So, good conversation. Going back to the launch of SpaceX, the historical aspect of that IPO and kind of what's been going on with that stock, and then the question that we got on funds and individual stocks and trading.
Yeah. I mean, good
conversation. SpaceX is up 15%, by the way.
Yeah. We've got, there's a lot of stuff happening this week that we may cover in next week's podcast, but you've got, the World Cup is in North America. There's a lot of cities in the United States that are benefiting. You think hotels, restaurants, shopping. I mean, hundreds of thousands of foreigners are in the U.S. for the next month and a half. You've got price of oil's dropped 30% from the high.
Yeah. We didn't even touch on Iran and what's happened the last few days.
That's significant because, now let's talk about it a week from now. Has everything held for a week? But I mean, this morning, price of oil dipped into the 70s. We haven't seen that in a while.
It's been a little while.
So, you got the Fed, Chairman Marsh. Marsh, what's his last name?
Kevin Marsh.
His first meeting is this week.
Yeah.
100% chance that they'll leave rates alone. But with this deal with Iran, I mean, that the things will look different the second half of the year. Because, I mean, I think a lot of folks had already priced in a rate hike, between now and the end of the year. Who knows if gas can come down, oil prices or gas prices come down, that'll affect a lot.
Yeah, there'll be
inflation.
There'll be plenty to talk about over the coming weeks for sure. Well, as always, we appreciate you guys watching, listening, tuning in. Whether you're listening on Spotify, Apple Podcasts, YouTube, however you enjoy listening or watching, we appreciate it. Send us an email, comment. We love getting those questions and being able to talk through those. So we really appreciate if you do that. Hope you guys have a great week, and we will see you next week.
Take care.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.